For many Americans, it seems a starter home is a thing of the past. It used to be that the down payment is what hindered people from purchasing a starter home. Now, buyers are faced with the exuberant cost of everything, especially a mortgage payment. But how did we get here? Why are home prices so high? The average price of a home right now in America is $510,000. That's a starter home in some parts of America. Yet in other regions, you can buy a brand new home, just like this one, for $250,000. If you're new here, my name's Wayne Turner. For some 30 years, I've helped thousands of people buy and sell their homes. I'm going to shed some light into why home buyers are being crushed out of the housing market and why the talks of a reverse housing crash could push home prices even further out of reach. You see, a reverse housing crash is just the opposite of a housing crash. You probably know that a housing crash is when people can't afford their homes. Bankruptcies, foreclosures, short sales, people giving their houses back to the bank, cash for keys, prices go down. A reverse housing market is just the opposite. The interest rates doubled within a 6-month time frame. As a result, it put a freeze on the housing market. People that live in their current homes, they're not even moving because they have such a low interest rate. But when interest rates drop to the point where it's comfortable for people to afford the homes at the prices that they're at, you're going to see a feeding frenzy. You're going to see people coming out of the woodwork, if you will, and investors to buy houses. And when they do that, it's going to create a demand. That demand is going to push up home prices. The good news is it's not going to happen overnight. However, I need you to look for interest rates going below 6%. Once you see mortgage rates go below 6%, you're going to see a whole lot of people come off the sidelines, and that may be in the very near future. But how did we get here? How did we get to the point where the average sales price of a home in the United States is $500,000? For starters, you have to understand from 2009 to 2022, for 13 years, mortgage interest rates never went over 5.25%. As a result, home prices remained affordable, and that affordable home price meant more people bought homes, and more people bought homes increased the demand, and thus the home prices went up. And then you have to understand that they doubled the interest rate. So the interest rates went from around 4% to 6.5% in literally about a 7-month window. That pushed a whole lot of people out of the actual housing market where they could not even afford the homes. You see, home prices are high, but you have to look at people aren't paying cash for homes. Most people get a mortgage. And you have to know that 73% of people that have a mortgage today have less than a 5% mortgage rate. This means that people are not putting their homes on the market because they have a very comfortable mortgage payment. You see, a $400,000 house at 6.5% is going to run you $2,850 a month, principal and interest. That's before taxes, private mortgage insurance, and homeowners insurance. That same mortgage payment would be around $2,300. So you can see it's $500 difference just in a simple adjustment in the interest rate. But you know, the crazy thing is I talk to a lot of people and they tell me, Wayne, I couldn't afford my current mortgage payment if I had to refinance or buy the same house at a 6.5% rate. You see, the difference in between a 4% rate, a 3% rate, and a 6.5% rate could be anywhere from hundreds, if not thousands of dollars on a monthly basis. So I have people say, wait, we couldn't afford to actually move from our house. And most people don't just make a lateral move. If they're in their home, they want to move to a home that's maybe bigger, one that has a garage, one that maybe has a pool or a little bit of land for different reasons. And unfortunately, there's people that are kind of mortgage locked, if you will, and stuck in their current home. However, it's not just the interest rates that are pushing up these payments. You see, there's this thing called property taxes that play a big part in your mortgage payment. You pay that on a monthly basis within your escrow account. And when you look at states like New Jersey, Connecticut, New Hampshire, New Jersey being the highest state in the land in America for property taxes, a $385,000 home in New Jersey is going to run you about $8,200 a year. And you divide that over the 12 months and then you tack that onto your payment. Now, there's other states like Alabama, Mississippi, South Carolina, Louisiana, where it's a little bit more affordable when it comes to taxes. That's why you've seen a lot of people merging to those states. Take, for example, South Carolina, $385,000 house in South Carolina. Instead of paying $8,200 like in New Jersey, in South Carolina, it's $2,200 a year. But something else you need to be made aware of is every county and every parish is different. Some are higher than others. Some are more expensive to live in than others. And if you live within city limits, you're going to always have to pay city taxes. If you're outside the city limits, of course, you don't have to pay city taxes. However, you may have to pay a little bit more in homeowners insurance if you're a good distance away from a fire station. Now, there's one mess up that people make, and it is so easy to miss, and lenders will do it. You maybe have had this done to yourself. If so, chime in, comment, give us a thumbs up. It's when you purchase new construction and you have a great payment and you love it. It's great. However, after the first year, you get notice that your property taxes have gone up $200 to $300 because they assessed just the lot. They didn't assess the lot and the house. And they didn't account for the value of the house, even though they knew what it was worth because you had it appraised and closed on it. Now all of a sudden you have a bump in your escrow payment. So you have to write a big check for $1,400 to $2,000, or you have to pay a couple of hundred more dollars each month on your mortgage payment. That being said, taxes are going up all around the country based on the value of the home. The more expensive the home prices go up, taxes go up. However, it's not just taxes. You also have to factor in insurance. Between fires, floods, hurricanes, tornadoes, homeowners insurance is higher than it's ever been in the history of the country. But yet there's one more thing that you have to pay each month. And that one more thing is private mortgage insurance. It's windy, about to lose my rug. Private mortgage insurance is an insurance policy that the mortgage company takes out on you in case you default. If you don't put 20% down on a property, you're at a higher risk of default. And in doing so, you have to pay the monthly mortgage insurance premium. Now, there is an exception to that if you do a Veterans Administration loan. If you do a VA loan, the United States government insures those loans, and you don't have to have private mortgage insurance. But if you do conventional, you do FHA, you do like USDA, you're always going to have private mortgage insurance if you do not put 20% down. Now, if you or someone you know is a veteran, you need to look at a Veterans Administration loan for a couple of reasons. One, there's no private mortgage insurance on a VA loan. The federal government insures the loan. The second thing that's really cool is they will loan you up to 100%. The seller can pay all of your closing costs. And the third thing is, if you wanted to purchase a $1.5 million home, as long as the lender will lend you the money, the federal government doesn't have a ceiling on what they will insure on a VA loan. And of course, if you're like a lot of people, saving up 20% can take quite a while, and you never know what the interest rates are going to do, and home prices certainly aren't coming down anytime soon. Added to that, the average price of an automobile is $48,000. The average income in a household of America is $80,000. And then you have $33,000. $33,000 is the average household credit card debt, which, by the way, is the highest that it's ever been in the history of the United States. The good news is there are opportunities for you to purchase a house, and you don't have to have a large down payment. You can do VA if you're a veteran. You can do FHA. You only need 3.5% down. You can do USDA. You can do conventional. There's lots of opportunities out there. I did a video on that you may like. Be sure and give me a thumbs up. Subscribe to the channel. Watch this video. You'll learn something new on every episode.